Good afternoon, everyone, and welcome to Power Lunch. I'm Tyler Matheson, and we start with a check today on the markets. After a volatile week, stocks are a little bit mixed right now. Dragging on the Dow today, the safer defensive plays like Procter & Gamble, Johnson & Johnson, and Coca-Cola among them, all with red losses there, as you see. Walmart, the biggest percentage gainer on the Dow today, on pace for its third straight up day. Its earnings come out later this week. We'll have more on retail coming up shortly. But let's start with the setup for the markets following last week's big moves. The major averages down 3 or 4% for August so far. But even with those losses, let's keep perspective here. The S&P 500 and NASDAQ are up 12% or thereabouts for the year so far. Let's bring in Mike Santoli for more. Mike, welcome. Good to have you with us. As we look into this week with a couple of key earnings, most notably from Walmart and a couple of others, what are you seeing?
Well, mostly what we're seeing, Tyler, is some apprehensive action, certainly calmer. There's no more of that mini panic of people trying to get out of big leverage trades. That was a week ago. What we have right now, I think, is a little more akin to a fairly routine growth scare in the economy. So I think what the market needs is some kind of reassurance, or it's craving reassurance, that the U.S. economy, the consumer, remains relatively healthy. That's, to me, the battlefront right now is, are we still preserving the possibility of a good soft landing? Has the Fed waited too long or not? So in that sense, the inflation numbers are important this week, but it seems as if they ought to be subordinate to what happens either coming out of Walmart and Home Depot or the retail sales numbers. I do detect a little bit of unsettled activity below the surface, by the way, too. Most stocks are down today. Most stocks certainly are down from their open today. Even regional banks, which got a bit of a lift earlier on that key corp investment news, have backed away. So it shows you there's not a whole lot of conviction about this having been a real viable pullback in the markets, even though it still does look fairly ordinary in the context of a longer-term uptrend, as you were saying.
Yeah, as you look at it and you look at last week, if you think back to where we were last Monday, it was a very, very bad day. But then the market seemed to right itself, I guess. I mean, it was choppy. It was a lot of buffeting up and down. But by the end of the week, you didn't feel like you had sustained major flesh wounds.
Not much, no. And I think that really time helps when these types of episodes happens. If you feel as if it's forced mechanical selling, at least in part as an exacerbating factor for a day like last Monday, the more days you go without seeing one of these storms unleashed again on the market in terms of heavy pressure on the sell side, it makes you feel as if, okay, we can sort of have regular old two-way activity in the market and not have to worry about it. The question is always, are we in the middle of the horror movie where we think we've outrun the monster, or are we at the end where, in fact, we know he's gone?
All right, Mike, stay there. Our next guest says last week's sell-off was very likely overdone, but he expects continued volatility and will be watching this week's economic data closely. He's David Spica, Chief Market Strategist at Turtle Creek Wealth Advisors. So last week, David, nothing really to get terribly excited about, a little bit overdone, you say?
Yeah, I think the yen carry trade was a big part of it, Tyler, which I'm sure you've talked about ad nauseum at this point. But when you look at where the economy is today, unemployment is still very strong at just over 4%. Wage growth is growing at just under 4%. The Atlanta Fed is estimating third quarter GDP of 2.5%. And let's don't forget earnings, Tyler. Earnings growth came in double digits for the second quarter. But importantly, the non-Mag 7 companies produced the best earnings growth they've done since the fourth quarter of 2022. And that's one of the things we've been worried about, is we needed to see that broadening out. We're seeing that now. So that gives us confidence that there's room to run here.
And yet there has been some earnings caution, hasn't there, David, in some of the commentary of some big companies?
Yeah, there absolutely has, Tyler. And think of where we are in the cycle. I mean, the Fed last raised rates over a year ago. So we're really starting to feel these rate hikes. But one of the things you need to do in this part of the cycle is look for companies that have visible revenue and earnings growth. A lot of the commentary was around cost cutting and AI capital expenditures slowing down projected AI growth. But there's still plenty of good companies out there. And like I said, you're seeing good earnings growth and good revenue growth out of the non-Mag 7. And I think investors need to start being a little more particular about where they're putting their money. We can't just throw it all at the Mag 7. We need to look for other opportunities in the market, the values, the cyclicals, the small caps. And it was good to see those companies start to outperform the Mag 7 even before this most recent downturn.
Let's presume that the Fed does cut interest rates. We'll learn a little more when they go to Jackson Hole, I suppose, in terms of context. But let's assume the Fed cuts rates a month from now. Is that probability all but already priced into stocks? In other words, would you expect to see certain subgroups of stocks or stocks generally go higher on a rate cut, or is it all sort of already in the numbers?
That's a really good question, Tyler. I would say 25 basis points probably is priced in, and you're going to see home builders and consumer stocks and certain companies do better on a rate cut, banks, financials. The one thing we don't want to see is we don't want to see the Fed overreact and cut 50 basis points, because that would indicate that they're panicking, that they believe they're behind the curve. And I think the market would take that negatively. So let's stay the course. Jackson Hole probably won't tell us a whole lot. We're going to get CPI this week. We're going to get August employment report in early September. And these are things that we need to be looking at. But 25 basis points is probably priced in. And quite honestly, we think that's probably the best case right now. And that puts us on that rate cutting cycle, which eventually gets us to the neutral rate for the Fed, which over time is probably around 3%.
So, Mike Santoli, are you with the idea that rate cuts are that at least a quarter point rate cut is probably already priced into stocks, and to address David's other point, that a 50 cut, a cut of a half point, would be maybe a sign of panic?
I don't know about panic, but I would say resolve. I think there's an acknowledgement out there that Fed funds above 5.25 is way above the 2-year Treasury yield, way above the rate of inflation. So there's a lot of room in there to cut. To me, it's all about whether, when the Fed eventually does ease, is it in the context of an economy that's still hanging in there so that they seem as if they're doing an optional, deliberate, orderly easing cycle as opposed to really rushing because they've fallen behind. So that's, to me, what, the next 5 weeks or so, whatever it is, until the Fed meeting in September, as the data come in, and that's going to fill out the picture as to whether, they're kind of still in their preferred path of doing these insurance cuts and just making the policy less restrictive as opposed to chasing a failing economy.
Yeah. Back to you, David, for a couple of stocks that you like, and one of them would be a direct beneficiary, I suppose, of an interest rate cut, and that is Lennar, the home builder.
Yeah, that's a good example of a company that's growing the top line, one that will benefit from a rate cut. When you look at where we are in the cycle, Tyler, we've still got an undersupply of houses in this country, have since the housing bubble collapsed back in '08. Filing mortgage rates have already started to create some activity there. Fed rate cuts will improve the landscape for home builders. And we like Lennar because they're vertically integrated. They're doing more than just building single family houses. They're doing mortgages, multifamily, land deals. And so they've got an opportunity to really benefit from lower rates and from a need that we have in this country for more housing.
All right, David Speaker, Mike Santoli, thank you very much. Appreciate it. All right, and now let's turn to the bond market as yields are falling ahead of the key inflation data that comes out later this week. Rick Santelli is in the center of the country, Chicago, for us. Hi, Rick.
Hi, Tyler. Indeed. Tomorrow's July PPI reading might not get the same scrutiny, attention, or move the markets as much as the following day's CPI, but it is coming first, and it does draw many eyeballs to one situation, and that is April, May, and June on year-over-year ex-food, energy, and trade have all been over 3%. 3 in a row over 3%, even though last November we're all the way down at 2.5%. So this is very interesting to pay attention to because these year-over-year readings are running a bit warm. Now, we look at the VIX. It did some trading under 20 today, and some of the agita that we've been discussing from last week might be dispensing, leaving the market for a brief time. But we are definitely hovering, idling right around 4% in both 2s and 10s. And if you look at a 3-day chart, 2s, they stuck. 3 days ago, they popped over 4%, and they have been closing over 4%. That same 3 days ago, the 2s and the 10s were hovering in positive territory briefly, but the 10s have reversed down a bit. And as you look at the wider charts going back to May of last year, you can see that 2-year are definitely hovering at 15.5-month lows, 10-year around 1-year lows, but they really are giving up some big ground on the rate side of the equation. And it's causing many to think that should we start to see some convincing trade under 4% in 2s, that really would trigger a lot more buying. And I think that goes along with your last discussion. If we get a rate cut in September, look for the market to think we're going to get lots of rate cuts to follow. Tyler, back to you.
All right, Rick, thank you very much. New numbers from the Treasury Department on government spending, we can only imagine. Megan Casella has those details from D.C. Megan.
Hey, Tyler, so interest costs on the national debt keep on soaring. That's the top takeaway here. The U.S. government spent $89 billion in interest on the public debt in July, according to new Treasury data out this afternoon. That's a 21% jump from July of last year, as the debt has grown and interest rates have stayed high. For the fiscal year to date now, interest costs are now 32% or $231 billion above where they were this time last year. Some of the biggest line items on the spending side are directly tied to higher interest rates. Spending at the Department of Health and Human Services was up 10% last month versus last year due to higher costs for Medicare. And spending on Social Security was up 6%. Those are rising both because of the higher cost of living and because more people are now receiving Medicare and Social Security benefits. But tax receipts were also up 11% overall for the fiscal year so far, while total spending is up only 6%. So top line, Tyler, for the fiscal year so far, the government is running a roughly $1.6 trillion deficit. That's 5% smaller from this time a year ago. Tyler?
I guess we can take a little solace, a little heart from that. Thank you, Megan. Megan Casella. All right, coming up, some key retail earnings on deck over the last couple of weeks. We've seen some cracks forming around the consumer, especially here in the U.S., and specifically on the higher end. So what will we learn from Walmart? Not exactly the higher end. That's next. All right, welcome back to Power Lunch, everybody. A big week ahead for retail earnings as they kick off this week with some of the big box retailers, including Home Depot and Walmart, reporting their sales. Retail data sales for July also out later in the week. Investors will pay close attention as we will get a read on the consumer and the economy. And let's talk a little bit more about that with retail expert Brian Gildenberg, Managing Director at Retail Cities, and our own Melissa Repko. Welcome to both of you. Brian, let me start with you because I thought there was one thing that was very interesting in my notes, and that is your view that Shein and Temu, the two Chinese retailers, are kind of resetting the bar for where a discretionary treat may be. And I assume that means in terms of price, they're bringing that bar down lower and that may ripple through the system.
Yeah, I think first, good afternoon, everybody. And yeah, I think there's a chance that if you think about discretionary treats and purchases as a category, that the mix in that category is shifting to lower ring items. And I think Shein and Temu, and then their cousin, which is basically TikTok and the commerce enablement of TikTok, all of those things, I think, are changing the dynamics of how treats are affordable in the United States and what people expect to pay for a pleasant surprise or discretionary purchase. And I think that ties out really well with shoppers that are being anxious, nervous, or cautious about discretionary purchases.
So it's an interesting thesis, Melissa, there that Brian has. But how big are Shein and Temu, and are they big enough if this phenomenon is true to move the needle for other retailers?
That's a good question, Tyler. When I think of Shein and Temu, I really think of the apparel space with Shein. And then also Temu is a lot of the things that are kind of commodities that you get on Amazon. So the question is, how much are they pinching Walmart? And will that become more of a factor over time? Something to watch for sure, not so much the case with Home Depot. So Home Depot is kind of in a different category. Tomorrow when it reports, it will be talking more about the interest rate and the pressure on that, more so than the pressure on the consumer.
Well, Brian, why don't we take up where Melissa just left off and talk a little bit about the home stocks, which would be Lowe's and Target. Lowe's and Home Depot. What are you expecting there?
Yeah, I think certainly with Home Depot and Lowe's, they continue to be, and I agree with Melissa that Temu and Shein are not the relevant dynamics for them. They're much more sensitive to interest rates and what's happening in the housing market, which does not appear to be changing dramatically from where it's been. So you had some commentators on earlier in the show that talked about expecting some continued softness, and that's what we would expect to see as well. I think for Target, I think both Target and Walmart might benefit from the fact that their quarter ends in July, as opposed to Amazon, who reported that ends in June, because their Prime Day shopping season is going to be in July. And I think there's a chance you'll see that Target and Walmart, that both had encouraging quarters in terms of how shoppers seem to be responding to their messaging around their equivalent of Prime Day. You might see a little bit of an upside in discretionary spend with them because of the overall impact of basically the middle of July turning into a shopping holiday for Americans these days.
Brian has given us his view on those stocks. What is the street expecting from, let's say, Walmart and Target?
So with Walmart, there's a pretty optimistic take in general on Walmart, and there's a couple of factors. Not only is Walmart better positioned as the nation's largest grocer, so it has more staples, but also it's been making some of its own strategic moves, growing its marketplace, growing its advertising business, some different factors that make it a little bit more resilient even in a tough economy. And it's even introduced a private label that caters a little bit more to both customers who want more of that Trader Joe's fun meal solution and to people who may be looking to an alternative to fast food, because fast food, as we know, has been stubbornly more expensive. And that's why McDonald's has introduced the value meal. They're competing a little bit with Walmart as people might cook more at home. So that is one positive thing working in Walmart's favor. With Target, they lean a little bit more heavily on discretionary, and that may make it a tougher quarter for them as they report next week.
In other words, they don't have the same footprint in grocery, particularly as Walmart does have. So, Brian, final thought here on Home Depot and Lowe's and the effect that a falling interest rate cycle might mean for them.
Well, I think in general, what needs to happen, not just for Home Depot and Lowe's, but for the economy in general, both for the housing market and for renters who are paying a ton at the top end of the rental market, a reduction in interest rates that improves liquidity in the housing market will create sort of more of the natural movement in the housing market that Home Depot and Lowe's rely on. Also, by the way, Target does as well. Target does a remarkable amount of business when people move. Like if you think about it, the first place you go after you move, if it's not Home Depot or Lowe's, is Target. So that stagnancy in the housing market and the lack of mobility, I think, is impacting all of these businesses. I do think a reduction in interest rates will free up more home purchasing, and I think that will help all of those businesses.
I'll tell you another place Target cleans up. I'm taking my son through his freshman year of college.
Back to college,
Let me
yes,
tell you,
indeed.
Target is going to clean up this weekend. Get ready, Bloomington, Indiana. All right, Brian, thank you very much, man. Appreciate it. Melissa's going to stick around because we want to ask you about Macy's. That stock is down 20% this year as it continues to struggle with the retail environment, the real estate environment as well. Planning to close now 150 more stores by 2027, literally changing the landscape. You got a story on .com telling us more about it. What's going on there?
So as Macy's closes nearly a third of its stores, if you think about the size of the boxes it will leave behind, it raises a lot of questions about what will malls look like in the future as those boxes become empty. And I spoke to a lot of real estate experts that were saying that a lot of the use cases are very interesting. In Utah, for example, a former Macy's is becoming a practice rink for the new NHL team in Utah. That's an example that's very creative, but we're also seeing things like housing moving into that space. There's a need for housing, and apartment complexes can be tacked onto a mall, or that box can be demolished and turned into something new, even retirement communities. So this is becoming a whole new amount of square footage. And I've seen this play out even in my own hometown. I'm from Northeast Ohio. There was a former mall that was dying, and it was demolished, and ultimately it became an Amazon fulfillment center. So these are examples of how you're kind of seeing the retail circle of life as a big anchor moves out, and in some cases that Macy's will be the nail in the coffin, but also it could be a chance to reinvent the mall with other use cases like entertainment, restaurants, bowling alleys, and things like that.
Yeah, it's interesting. You see it happening all over the place, and I see a lot of big gyms going into those spaces. I see urgent care centers going into some of those stores, some of those spaces. Maybe not at the scale of a Macy's, but you subdivide the Macy's and you get several.
The other interesting piece here is that historically Macy's has owned a lot of those spaces. So it hasn't been a normal agreement like a landlord would say, hey, we want to get a new tenant in. So the landlord, which is the mall owner in a lot of cases, will have to be buying out Macy's. And that could be a cash infusion for Macy's as it tries to restore and revive some of the stores that it keeps open. It's going to keep about 350 namesake stores open, and it says it's going to invest that money back into the mall.
Back into the mall. Will they be adding their other brands like Bloomingdale's and was it Blue Mercury?
Yes, those two names will be opening new stores, whereas Macy's, its namesake stores, will be shrinking in size.
All right, Melissa, thanks.
Thank you.
Appreciate it. Melissa Repko. All right, coming up, what are your options when trading Google? The Market Navigator is next.
now.
Welcome back to Power Lunch. And today's Market Navigator, one options trader thinks last week's re-rating of Google has made an already attractive stock even more so, but he's wary of lingering volatility. Tony Zhang is chief strategist at Options Play and a CNBC contributor. He joins us now. So, Tony, welcome. Good to have you with us. What is your Google trade?
Yeah, here we're going out to the September 13th weekly expiration. We're selling the 160 puts. Earlier today, you can collect about $3.33. And with this type of strategy, what it does is it obligates you to potentially buy the stock at effectively around $156 if Alphabet's below 160 by that September 13th expiration. It's a strategy where for every contract that you sell, you can potentially acquire 100 shares of with a pretty significant discount when using the strategy.
All right. So then what are you seeing here that tells you this is an opportune time to execute this kind of strategy? Are you seeing that Google is back at a key level?
Yeah, absolutely. So first of all, you're at pretty compelling valuations. Even before the volatility last week, we were already at selling Alphabet at pretty compelling valuations. But the fact that we've had this sell-off, you're trading at about a little over 20 times forward earnings at the moment. And given the fact that it's expected to grow faster, both top and bottom line than its industry, and it has better margins than the rest of than the industry, I think that it's the fact that it trades at a pretty significant discount at this point, about a 20% discount to its industry, means that just from a valuation perspective, it's quite compelling. Out of the Magnificent Seven, it's by far the cheapest stock to look at. But also the volatility last week has made options very expensive, and that's to the advantage of an options seller. And that's what we're doing here is we're selling put options to potentially acquire the shares, and now we're actually collecting more premium, which means that we're going to get a bigger discount on the stock purchase. So if this put gets put to you on the September 13th expiration, which is about 30 days away, you're going to be able to potentially buy Alphabet here at just a little under 20 times forward earnings, which I think is downright cheap, not only relative to the industry, but also relative to the market as well.
Quick answer, if you can, for those of us like me who need to slow down when we start talking about options. How does this trade make money?
So this makes money in two ways. Either the stock stays put where it's trading right now or moves higher. In those two instances, you're going to collect $3.33, which for each contract that you sell, which is about 2% yield on your cash in just 30 days. That's a really nice yield if Alphabet simply stays where it is or moves higher. In the other instance, if it declines below 160, now you own the shares at 20 times forward earnings, which I think is a good long-term investment.
All right, Tony, you win two ways. If it works, it's great. Tony Zhang, thank you very much. We appreciate it. Thank you.
Thanks, Connie.
All righty, two controversial figures sitting down for an interview. One is Donald Trump, the other, Elon Musk, one-on-one. We will discuss what to expect. Will there be fireworks, and of what sort? Interesting stuff there. The Musk-C interview.
Brexit.com.
Shares of Donald Trump's media company Truth Social, or Trump Media and Technology as it's more formally known, are down today, about 7%, though up almost 40% year to date. The company reporting results late Friday, a net loss of $16 million on revenue of $837,000. And today, the company's namesake is expected to be interviewed by Elon Musk on a rival social media site called X. Steve Kovac joins us with more.
I was going to say, if one guess what rival social media site that is. Look, this is, Tyler, going to be the next level in that budding romance we've been watching between Donald Trump and Elon Musk. Tonight, Musk is going to be hosting that conversation with former President Trump, 8 p.m. Eastern. That's going to be on X Spaces, audio only. No idea what to expect here with these two men. Musk tried this last year when Florida Governor Ron DeSantis announced he was going to be running for president. Well, X kind of melted down on that one. It was a complete disaster for the coming out campaign for DeSantis. All we know, though, two of the biggest personalities in the world are going to be broadcasting their conversation. In the meantime, Trump today made his return to X, posting what seems to be a campaign video. Now, in one case, it was labeled as an advertisement, but also kind of unclear if that is a regular post or not. There are some regular posts as well. But look, it's unclear who is really, if he's spending real ad dollars on X. But look, last month, we do know the history between these two. Musk endorsed Trump after the assassination attempt and also has a Trump supporting PAC that he has been bankrolling. And just today, the Wall Street Journal reporting the PAC's mission is to convince 800,000 voters to go for Trump. The big question, though, is who is this event for and who is really benefiting? On the Trump side, basically talking to his own audience already, similar to that Mar-a-Lago press conference we saw last week. But on the Elon Musk side, you get some good engagement on X and likely more attention, and not to mention potential advertising dollars from the Trump campaign.
Is this a kind of welcome back to X?
It seems like it. He's Trump has, or at least
Trump,
it seems to be not him posting, just the way it is and the language they're using. A lot of campaign videos. Again, one of them I've asked appears to be an advertisement, a political advertisement. In some cases, it was labeled that way. And if so, that is a big telling thing for what's going on in X and Truth Social.
Has the former president posted personally on X yet?
It doesn't seem like it. I mean,
or is he just stuck with Truth Social?
But for the most part, before today, his last post was his mugshot. So he did post that on X. Elon Musk, of course, famously, after his account was removed after January 6, 2021, he was reinstated.
Restored.
But he's been barely using it. Most of the communications on Truth Social. But you see Truth down 7% today. Of course, their earnings didn't look so great. But the fact that the namesake of that company is now going to the rival platform to do this, what I guess is a campaign event or campaign adjacent event, tells you a lot about, the power he thinks of the platform.
Relative power.
Or it could just be, playing up to Musk and cozying up to Musk. Musk is, of course, providing a lot of money that Trump needs.
The guy's going to write you $45 million every month. That would be a reason maybe to patronize his service.
And maybe put some ads on there as well. Yeah.
All right, Steve, thanks.
Thanks.
Good to be with you. Well, let's get to Bertha Coombs now for a CNBC News update. Bertha.
Tyler, voters in North Dakota will decide whether to legalize recreational marijuana during this November's election. The state said that nearly 19,000 signatures were accepted to place the issue on the ballot. North Dakota voters legalized medical marijuana in 2016, but rejected recreational initiatives in 2018 and 2022. Brazilian authorities over the weekend retrieved the remains of all 62 passengers from the wreckage of a plane crash on Friday in the state of Sao Paulo. Investigators removed the plane's 2 engines from the site and recovered the black box containing voice recordings and flight data. The cause of Friday's crash still unknown, but a preliminary report is expected within the next 30 days. And gym operator Blink Fitness has filed for Chapter 11 bankruptcy to help facilitate a sale of its business. The Equinox-owned chain said its gyms will stay open and that it received $21 million in new financing from existing lenders. Employee wages and payments to vendors are expected to continue without interruption. And presumably, Tyler, you would need to keep making your membership payments as well.
All right, Bertha, thank you very much. Bertha Coombs. Up next, when it comes to climate change, we often focus on carbon emissions, but methane is even more destructive to the planet. We will dive deeper in today's Clean Start. Welcome back, everybody. We talk a lot about reducing carbon emissions, but methane is actually even more destructive to the planet. One company, however, is working on technology to eat methane. Diana Olick has the details in her continuing series on climate startups. Hi, Di.
Hey, Ty. Yeah, it sounds gross, but I'm going to introduce you to something called a mem. Not a meme. I promise I'm saying it right. A mem is a methane-eating microbe, much like yeast that eats sugar in bread and produces substances that make it rise. Mems eat methane and produce fertilizer, all the brainchild of a startup called Windfall Bio. Methane is a potent greenhouse gas that traps far more heat in the atmosphere than carbon dioxide. Getting rid of it is essential to reaching global climate goals. And while much focus is on reducing methane emissions, California-based Windfall Bio has come up with a way to get rid of existing methane. Naturally occurring microbes that live in the soil and eat methane as food.
We provide those packets of MEMS, and then whoever has access to that methane can capture the methane themselves, turn it into fertilizer, and create the value from it.
If a farmer is using the MEMS, they can turn around and use the fertilizer themselves. If it's an oil producer or a landfill, Windfall will buy the fertilizer back from them so they get paid for capturing methane.
So it's still a profitable, useful process for them.
Windfall has been researching this for a decade, but just launched 2 years ago.
I've actually been honestly fairly shocked at how high the demand is. We have customers now on basically every continent, and we have more inbound interest than we can even supply.
Investors, however, say they are not concerned about it scaling quickly.
We've seen the data and feel very compelled by what we've seen thus far. And we'll continue to progress this in a number of pilots across a number of different industries going forward.
In addition to Cavallo Ventures, Windfall is backed by Prelude Ventures, Amazon Climate Pledge Fund, Breakthrough Energy Ventures, and Mayfield. Total funding so far, $37 million. And another benefit from using MEMS is that traditional fertilizer production requires a lot of energy and produces huge carbon emissions, especially in making ammonia fertilizer. Windfall Bio says they're soon launching a program with Whole Foods market suppliers, specifically their dairies, to eat up the methane. Tyler?
Di, I don't know whether you know the answer to this, and forgive me for asking if you don't, but how are these MEMS deployed so that they gobble up the methane? What, do you just sprinkle it around places that methane is produced, or what?
Exactly. Okay, so let's say you're on a dairy farm. You could put the MEMS at the end of an exhaust pipe that comes out of the dairy farm. Or if you're putting them on agricultural land, you could use tarps and put the MEMS underneath the tarps, and they will then suck up the methane. If it's at, a smokestack or something where they often do carbon capture, and they do different types of pipes that come out of that smokestack, you put the MEMS there. You put the MEMS wherever the methane is so it can have its dinner.
Is there competition in this space? Anyone else in the methane eating game?
Not in the methane eating game. There's, of course, a lot of competition in the fertilizer space, and there are different methods now being used to either capture methane or reduce methane, but not methane eating microbes. No other MEMS.
No other MEMS. All right, the MEMS stocks. All right. Di, thank you very much. Diane Olick. Still to come, Starboard betting big on Starbucks. We will trade that name and others in 3 stock lunch.
hero.
Welcome back. Time for today's three-stock lunch, where we look at Starbucks, Eli Lilly, and JetBlue. Here with our trade, Scott Nations, president of Nations Indexes. Scott, welcome. Let's start with Starbucks, which is up today on reports that the activist investor Starboard Value has added a stake. Elliott Management also in that stock. Wells Fargo optimistic on both activists' potential in a note this morning. Are you quite so confident?
No, I'm not quite so confident. Tyler, this is a hold. Starbucks is a hold. You don't want to be the focus of activist hedge funds, and Starbucks is the focus of two right now. As you pointed out, latest one is Starboard, probably best known for being the ones that told Olive Garden to start salting their pasta water. They both want the company to make changes to boost the stock price. Instead, the company has reduced guidance 2 times this year. It's down 20% year to date. Same-store sales have disappointed. And let's face it, Tyler, if you are a consumer who's feeling pinched by inflation, a $5 coffee is probably a pretty good place to start. And with the forward PE at 20, you can't even say that the stock is cheap yet.
All right, so that would be a hold, which sounds a little like a sell there, Scott.
Not quite a gentleman's sell, because we're going to let these activist hedge funds do their work. But if we get back to unchanged on the year, then I would be a seller. Right now, I think everybody is saying that they don't care so much about the cheese. They just want out of the trap when it comes to Starbucks.
All right, let's talk about Eli Lilly gaining 10% last week. Huge earnings beat. Deutsche Bank upgrading the name to buy this morning on strength in Mounjaro and Zepbound. Do you like what you see in Lilly?
I do. Eli Lilly is a buy. Sales are surging because of their weight loss drugs. That is no surprise. But the recent EPS beat was a pleasant surprise. Additionally, concerns about capacity constraints are easing. It would be horrible for a company to have a high margin drug that everybody wants and not be able to make enough of it. The option market, the only one of the 10 biggest names in the S&P where the option market is bullish. It is certainly not cheap at a forward PE of 52. You're paying for growth, but Tyler, so far you're getting the growth you're paying for.
You're getting the growth, and they seem to be, as opposed to some of their competitors, a little ahead on being able to meet the demand, the capacity question. All right, finally, let's move on to JetBlue. The shares there having their worst day ever after announcing a $400 million in 5-year convertible senior notes. This comes after posting a surprise profit at the end of July, but a capital raise here on JetBlue, Scott.
Yeah, this is a sell. The company is not profitable. They're raising a total of nearly $3 billion in bonds and loans, backed up by their frequent flyer program. Moody's just downgraded the company even further into junk, and their analysis was damning, saying it would likely take years for the company to increase its metrics enough to have some sort of reasonable positive cash flow and earnings in the near future. Listen, all the airlines, Tyler, are really tough businesses to be in, but you don't have to swing at every pitch, and you don't have to buy JetBlue just because we're talking about it. If you felt compelled, just had to invest in an airline, I would focus on one of the ones that had much more foreign exposure, foreign routes, because those tend to be so much more profitable.
All right, let's get a quick thought on the markets generally. The Dow is down about 1/3% right now, a little bit off its lows. NASDAQ and S&P are slightly higher. What are you looking for as we sort of wrap up the summer?
Yeah, Tyler, we've been back and forth, at least in the S&P, above and below the unchanged line today. It's nobody can seem to really get any sort of momentum going. I'm disappointed that that the market has not been able to sustain rallies recently in the S&P. The option market is still not just scared of volatility, but terrified of it. And so I think that we're going to see more of this as August continues. You know, a lot of people away. It's going to be tough to sustain much of any move. So I think that until we get a little bit more guidance from the Federal Reserve, 25 basis points, 50 basis points. I think it's going to be a pretty sloppy August.
All right, sloppy August. Scott Nations, thank you, my friend. Nations Indexes.
Thanks, Tyler.
And remember, folks, you can always hear us on our podcast. Always. Be sure to follow and listen to Power Lunch wherever you go. We will be right back. All right, let's give you a quick check on the markets right now. The Dow Industrial is off 161 points, about 0.5% at 39,335. S&P 500 wobbling a little bit between positive and negative right now. A second ago, up just a little bit. And NASDAQ slightly higher. This would be its fourth up day in the past 5 sessions, following that huge 3.5% drop that occurred last week. Up 0.25% right now. Meantime, shares of Disney are lower by nearly 20% over the past 6 months, as there are concerns about nearly every segment of its business, including even the money-printing theme parks. Julia Boorstin has more on Disney's future plans. Hi, Julia.
Well, Tyler, Disney's theme parks division did show a slowdown in its earnings report last week, but the media giant is betting that the parks and cruises division will drive growth for the company over the long term. This weekend, at its fan event, D23, showing how it plans to invest $60 billion in its Parks and Experiences division over a decade, a commitment which it announced last year. Now, the Magic Kingdom is getting a new Villains Land, along with an upgrade to Frontierland to expand the Florida park. California Adventure is building 2 new attractions, and Disney announced 4 new cruise ships, in addition to the 4 others already in the works and the 5 already at sea. Morgan Stanley with an overweight rating on the stock, saying they see the expansion of Disney's experiences division as notable, given its long history of high and rising return on invested capital. As the company's linear TV businesses struggle, CEO Bob Iger showcased new films designed to keep up the box office rebound that we've seen this summer, led by Inside Out 2 and Deadpool vs. Wolverine. Building on the success of those franchise films, 5 of the 7 films Disney featured were from popular franchises, including Toy Story 5 and Frozen 3. And as Disney makes its diversification push into the fast-growing Epic Games with the strategic investment into the company announced earlier this year, now they unveiled how they plan to really integrate those characters into Fortnite, starting with some new Marvel characters, which will be part of the game as early as this week. Back over to you, Tyler.
Julia, one of the things that really leapt out at me there was how much they're investing in cruises with 4 new boats in addition to the ones that they're already building. They're going to become a big cruise line, not that they aren't already.
Yeah, this is really part of their whole experiences business. The idea that if you are interested in bringing your family to the park, whether it's in Florida or California, then those big Disney fans really want to spend more money and more days and have this really immersive Disney experience while they stop off in various ports. So this is really based on all the research and the data of what Disney has seen about their fans. And what's so interesting to me is the fact that now they have this additional touch point with their fans. They have the direct relationship with the fans of the parks, but also through the streaming service and through those dedicated, to those dedicated fans, they could really start to market things more through Disney Plus. So that's another advantage of having this D2C relationship with the streamer, that they can market things like a cruise ship experience to them.
A little bit short on time, but in terms of scale, the expansions or the new features at the parks, how do they rank? Biggest ever or what?
So when they announced this last September, they said they were doubling their investment in the parks to $60 billion over 10 years. So really doubling down on that parks and experiences division.
All right. Very interesting. Always interesting to hear about what the House of the Mouse is doing. Julia Boorstin, thank you very much. And thank you, folks, for watching Power Lunch for a Monday. Closing bell will start in just a few seconds' time. We'll see you back here tomorrow. Thanks for watching.
Tyler, thanks. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. And this make or break hour begins with the risk reward for stocks, whether it's gotten better following last week's volatility. We'll ask our experts over this final stretch. In the meantime, check out the scorecard with 60 minutes to go in regulation here. The major averages are sort of taking a wait-and-see approach to this week's data deluge. We have inflation data, we have retail sales, we got some key consumer earnings as well, all lying ahead. Will be a good test for the markets for sure, given all these questions now about the direction of the U.S. economy. NVIDIA, it is one of the standouts today, along with other chip names like Micron and AMD. They're all positive across the board. Apple's higher too. That's his analyst Dan Ives. He's upped his iPhone 16 sales numbers. That stock's good for about 2/3%. Takes us to our talk of the tape, the outlook for stocks, which have a lot riding on these next several days. That's an understatement. Let's ask Cameron Dawson what's really at stake. She's the Chief Investment Officer for New Edge Wealth. Joins me here at Post 9. Welcome back. It's good to see you.
Good to see you.
Did we solve whatever issues we needed to solve last week?
We definitely solved some of the issue with positioning. I think that is the one silver lining that came out of last week, is that if you look at that Deutsche Bank consolidated positioning report, it went from being way extended, way overweight, 96th percentile. Now it's just 31st percentile. So that just suggests that you shook out some loose hands, and that does set the stage to draw more money back into the equity market. Now, there are still overarching concerns. Do we have a growth scare? What's going on with earnings? But I think at least from the positioning front, it's good.
Yeah, what about the carry trade that got all this attention? I guess no one really knows whether it's fully unwound or what else may lie overseas based on other central bank moves. We're so fixated on the Fed here, but we're learning that other central banks hold the key very much so to where this market may go too.
Certainly. If we look at things like CFTC positioning, which is not perfect for looking at yen positioning, it has bounced back a lot, meaning that a lot of shorts have been covered. But it does raise the point that we could still be in this world of higher volatility in FX markets. And we'd note mostly this week, high volatility within fixed income because we get CPI, PPI, and retail sales.
What do you think is most important, the inflation reads or the retail read, given this what felt like a panic attack we had a week ago today?
Because we think that there's a greater risk for downside to growth than there is a risk for upside to inflation, we think retail sales is actually more important. Of course, if CPI or PPI comes out hot, that could spark a lot of volatility, mostly in the bond market. Remember, the bond market still has quite a few cuts priced in, 4 cuts priced in through the end of the year. But if we think about that growth story, it really will give an eye to how accurate is the labor market data. If retail sales falls off, then we might know that the labor market could be weaker than maybe some of the headline data suggests.
The way you put this to our production team was what happened last week, quote, reset the clock for equities to give them more room to run. So it got through a lot of the issues that needed to be taken care of. And now what kind of runway do you actually see existing?
Yeah, so in theory, it resets the clock, meaning because of that positioning reset, it does help to at least start from a point where we're not as stretched. I think one interesting observation, though, is we went from very overweight positioning to now neutral, slightly underweight with relatively little pain. So as people get brought back in, do we get the same kind of boost than if it had come with a bigger drawdown within the market? The other thing to note is markets got a little oversold last week, but on things like percentage of names above their 50-day moving average, we got not oversold at all, which just suggests we really didn't see a true flush.
What surprised you more, do you think? The magnitude of the Monday sell-off or the magnitude of the rebound, where we finished the week, let's just call it for the S&P at least, flat?
Yeah, I think that it is absolutely incredible that you saw it end flat, given the amount of pain that was absolutely anticipated at the beginning of Monday, and that you quickly threw away this idea of growth fears. It really helped to focus in on that maybe all of the much ado that happened on Friday and Monday was just about positioning, and maybe the growth fears were just a narrative. But that doesn't mean we can't ignore growth risk, as we hear from companies like Walmart and Home Depot this week about the consumer.
So let's go positioning then. I mean, what are we supposed to do now in terms of what the best portfolio might look like? We went from overexposed maybe to mega caps at the expense of a lot of other stuff. Then mega caps sold off in July, and we had a nice reversal for some of these unloved areas. Now we have reintroduced volatility, so I'm not sure what we're supposed to do from here.
Yeah, for us, regardless of what the overarching narrative might be, we think quality is just so very important, because what we found over the last week in our quality-focused portfolios is that because we had valuation discipline, we had really good downside capture. Just means that we go down less than what the market goes down, but you can still participate in the upside because you're not full defensive. So it's that needle to thread of saying we want companies that can block and tackle if the economy is weakening, but we don't want to be crowded in areas like utilities or staples, which we know are perking up, which does get our eye about the risk appetite in the market, but those tend to reverse gains if you do see a better growth environment.
What about growth versus value? Predisposed to one side of that trade versus the other?
We've been neutral growth versus value this year.
Why? Why?
Because if you look at growth, what it has going for it is better earnings, but it's also very expensive and very crowded. If you look at value, it's had worse earnings revisions down, but it's under-owned and under-loved. What we've seen over the last couple of weeks is growth versus value has reversed sharply, where value has outperformed growth. It is sitting right at its 200-day moving average, so it is the most critical point to see the direction of that trend. We think it all comes down to earnings. Unless value can get its act together and have better earnings, which some of that relies on things like energy and commodities, then we think that growth can still outperform, maybe not to the magnitude, though, that it did at the first half of the year.
What about small caps? Everybody's weighing in at the worst last week. The Russell was down 5.5% last Monday. It finished down 1 1/3. So it had a nice comeback, but it didn't have as great a comeback as some of the other of the majors. Did you? I don't know if you saw the interview that I did with Tom Lee to end the week, but he's still optimistic, and you know he made a really big call months ago on where he thought the Russell could go, up 50%. I said, Tom, it's getting a little late for that. He said, well, rate cuts are going to be good nonetheless for small caps. Let's listen to what he said, and we can react on the other side. Tom Lee on Friday.
It's a lifeline for reducing the cost of money for consumers, which helps the banks. You have huge exposure in the Russell. So I think when the market believes the cuts are imminent, or maybe it's September, I think that's when the small cap call works. I think, we've been wrong on the timing. I would like to have seen us to be up 20% at this point, but I still think 50% could happen before year end.
I was kind of surprised that he said that. I still think 50% could happen before year end.
Yeah, mostly after we've already seen a big positioning reset. Since that early July kind of rebound within small caps, you've seen positioning get back, almost back to the levels it got to in December of 2023. We think small caps have to have a very, very specific circumstance in order to outperform. You need rate cuts and you need lower yields, but you also have to have a strong growth backdrop. You can't have one or the other. You have to have both at the same time, because if you're getting rate cuts because the economy is weakening, small caps are the most cyclical parts of the market. They're economically sensitive. So that's why a lot has to go right for small caps to work.
Do you think that's too heavy a lift?
I think that it's possible, but to bet on that happening and to the magnitude of 50% is a really far reach. What we say is that we actually do like some parts of small caps, but we like names that don't need rate cuts in order to do well. We like names with better balance sheets, with less interest costs. So it's highly selective. And we've been adding to small caps on that notion of if we can be picky, then that's where we think we can add value.
People like Rick Reeder, he joined me, Monday in the throes of it on this show. Said, I don't understand that call in the first place of, small caps. You can have money coming out of mega caps and you're going to go into small caps even with rate cuts because of exactly what you said.
Yeah.
You need everything to go right. You can't have any concerns about growth and then want to go into small cap stocks, can you?
You have to believe in a true economic acceleration. The only time we see sustained outperformance for small caps is really at the beginning of an economic cycle. Fed cuts rates, you have interest rates that are low, and you're rebounding off of the lows, and economic growth is improving and accelerating. That's the time to go way overweight small caps, not when we're having this debate as to whether or not we could be near the end of the cycle and slipping into a recession.
All right, let's bring in Ayako Yoshioka of Wealth Enhancement Group and CNBC contributor Greg Branch of Branch Global Capital Advisors. It's good to see you both. Aya, it's good to have you back. You say to our producers today, volatility is likely to be with us for a while, so we're still going to be stuck on a bit of a roller coaster for a while?
I think so. I think we've got a lot of, global macro headline risks that could always, disrupt markets. I think there's, the focus, though, on the long term and the fundamentals that can sort of balance those out so that we don't have too much volatility, over the long term.
Greg Branch, a week ago today, you were thinking what? Excuse me. And given the comeback that we've had, did that force you to change your view? For our viewers who have followed our conversations, you've been largely cautious for a pretty long time. I'm sure Monday was one of those instances you said, okay, this may be what I've been talking about, but what now?
Yeah, Monday was a surprise to me. And to go back to the question you started the show with, I think it revealed a problem. And I think Cameron hinted at some of this, is that I think we are, at least parts of us are in denial that a cycle needs to occur. So nothing happened 2 weeks ago that should have been surprising. The Fed has always represented to us that they needed to get to mid 4% employment for price stability. 114,000 jobs number is not out of line and certainly not even reaching neutral yet. We saw 150,000 in October. So I was surprised at the reaction when all we saw was the evidence that the Fed's program was working and what we should have expected when we saw the inflation numbers put up a very stark pivot for May, where we had 0 bips of core month-over-month growth, and June, where we had 10 bips of core month-over-month growth. But a cycle needs to happen. And because the cycle needs to happen, I agree with Cameron that I'm cautious of any permanent or long-sustained rotation into small caps at this juncture. And I think that once we realize that a cycle needs to happen and that growth will in fact slow and that it's the only way to embed a sustainable 2% inflation, that investors will flock back to where the earnings are. And there will be a stark difference between those companies that can grow 20% and those that will grow mid-single digits.
But are you implying that the cycle is ending now? Because the data doesn't necessarily confirm that. Slowing, yes. Ending, no. How do you respond?
Not ending. The slowing is in front of us. The Fed will not cut rates unless it needs to reaccelerate the economy. And it's unclear, and I'm in the minority on this, I'm unclear if that will be September. We had 2.8% GDP growth in the second quarter. The Atlanta Fed projects third quarter to be at 2.9%. earnings growth is going to come in at 11%. We've had 90% of the S&P report, we're at 11%. That's the highest since the fourth quarter of 2021. Consumer spending is basically unchanged the last few months. Yes, we had a contractionary ISM manufacturing report, but that's in line with what we've had the last year. The services report was 51.8%, which implies, roughly speaking, a 1.2, 1.3% GDP growth. So we haven't seen the economy crack yet. It's in front of us. And we're talking about rate cuts as though it will automatically alleviate that slowing, and it won't, because the hiking cycle will be slower. Sorry, the cutting cycle will be slower than the hiking cycle will, and it will take its time to work its way through the economy.
Cameron, you want to take issue with anything that Greg said? The Fed will not cut interest rates unless it needs to reaccelerate the economy. Does he have it backwards?
I think it's this great debate as to where we are versus where we're going. And it seems that the Fed is looking at where we are. They're looking at the data today, and it seems that they don't have much urgency. The bond market is looking at potentially where we're going, and that's where the urgency is being priced in. The bond market still has one supersized cut priced in into 2024. And the bond market has been getting ahead of itself multiple times. There's been many pivot parties over the last few years. And so it seems like those two are at odds. And that the Fed saying really no urgency, even doves on the Fed like Goolsbee not coming out and sounding the alarm suggests that maybe the bond market will get disappointed.
Aya, how do you see this playing out? Because I have people coming on the program suggesting that you should sell the first rate cut, not embrace it and buy it.
Hi, Scott. Yeah, I think that the labor market is going to dictate a lot of this. I think why we had the sell-off on Friday with the labor market data, and we're going to be paying attention to all the weekly jobless claims data that we get. That's going to really dictate how quickly the Fed moves, how much they move, and that's going to determine more than anything else.
I mean, Greg, the Fed, I think, is making it clear they're not going to wait around and let the economy fall apart and then first cut interest rates like you're implying. They want to prevent the whole thing from happening because I think they feel pretty good about where they are, where they somehow have been able to bring this plane along a way that many predicted was going to be a much more difficult landing than may be in the cards.
Right, and I'm not being critical, and in fact, I was very specific about what I was implying. If we have 2.9% GDP growth in the third quarter, as the Atlanta Fed is projecting, then we haven't seen the economy slow yet, Scott. And so when we're putting up 114,000 new jobs, that is not a neutral number. Is it coming? Sure. Of course, 80% of Americans have liquid assets that are about 13%. This was a study from the San Francisco Fed, 13% less than what they were projected to be pre-pandemic. So, the bottom 80% of earners are certainly stretched. But even in the retail numbers, they're the same. They're unchanged. Is it coming? Of course. Can the Fed avert it? I don't think that they want to. You got to remember, one of their mandates is price stability, and they have a failing grade against that for 3 years. So will they endure 4.3, 4.2% unemployment to make sure that our newfound price stability, which is probably imminent, is maintained? I think that they will.
A failing grade on price stability for 3 years? I mean, I think anybody would admit that they were sort of late to raise rates, but they seem, by virtue of their efforts, to be both swift and large in what they've done, that they may actually be winning.
Yeah, look, it is going the way that they anticipated, but we're not at 2%. And we had generational inflation for 2 years. So, look, I don't mean it to be minimizing. It's a hard job. But, yeah, we're not at 2%. We've had generational inflation for 2 years. I would call that a failing grade in terms of price stability. I think if you ask 80% of Americans, they'd agree.
Well, I mean, people who are sick and tired of paying higher prices for so many different daily products, I hear you. But they're also going to cut rates before inflation gets actually down to 2%. So anyway, when you look at positioning, because that's ultimately, I feel like, what the last week has been about, as Cameron said off the top. What positioning is best right now?
I I think we have to remember that diversification is your friend. I think we got lost in focusing so much on the mega cap tech companies that have really been the workhorses of the market for so long. But we can see that the broadening out of the market is actually a good thing for all of us. Diversification is positive for everybody in their portfolio.
Yeah. And we have, 2 weeks and a couple of days, Cameron, lastly to you on NVIDIA.
Yeah.
Is that the next catalyst for mega cap stocks? Is it the only sort of thing that's going to be the determining factor as to whether this trade has a renewed leg, whether it truly is in trouble? Is that the moment?
I mean, we are in this August quiet period, and so all eyes will be on it. And we do think it could be a source of volatility, and it will be probably more interesting, not the numbers, but the reaction to the numbers, because there's pretty high confidence that the numbers will be good based on all the trends intra-quarter that we've heard from NVIDIA. It's the reaction, and is good enough for a stock that's trading at these levels?
Good reaction today. You see it up better than 4%. It was a wild week, obviously, within the last 7. We'll see what happens. Aya, thank you very much. Greg Branch, good to see you as always. Cameron Dawson's good to have you back here at Post 9 as well. To Pippa Stevens now for a look at the other names moving into the close. Pippa?
Hey, Scott. Well, shares of Hawaiian Electric are sinking, on track for the worst day of the year after disclosing a going concern warning, saying it doesn't yet have a financing plan in place for the $1.7 billion in fees for the Maui windstorm and wildfire settlement. The company also suspended its dividend and posted a consolidated net loss of $1.3 billion in the second quarter. Shares of Marathon Digital also in the red after the crypto miner announced plans for a $250 million private debt offering, which could later be converted to stock. The company said it plans to use proceeds from the sale to acquire additional Bitcoin as well as for general corporate purposes. Those shares down 9%. Scott?
All right, Pippa, thanks. See you in a little bit. Pippa Stevens, we're just getting started here. Up next, your pharma playbook. Eli Lilly seeing some serious gains over the last week. STEM Point's Michelle Ross is back with us today to break down that rally. Find out if there's any more room to run there and where she sees big opportunities elsewhere in the biotech and pharma space. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC.
hers.com.
Welcome back. Eli Lilly taking a breather today after a scorching two-day rally. The stock up more than 14% in the past week. And that's after hiking full-year guidance on demand for its weight loss drugs. Deutsche Bank upgrading that stock to buy this morning, calling it a, quote, low beta, high growth unicorn. Joining me now with her outlook on the stock in the broader biopharma space is StemPoint Capital's Michelle Ross. Welcome back.
Thanks so much for having me.
Okay, what is our big takeaway from GLPs last week, whether it's Novo or Lilly?
Yeah, so I think Novo set the stage, and I think it caused a little bit of concern in the midst of what is a tremendous growth market and anticipation of this growth to what is the pricing dynamic on these specific drugs in this class of drug. And that was a fair question, I think, as you bring in more exposure to patients. When you include Medicaid coverage and Medicare coverage, you are talking about potentially different price points. However, when Lilly came out and discussed their view of the market, what they are seeing currently, I think they really did dispel any major fear that we were going into really a reversion to pushing on price. You actually had Dave Ricks, the CEO of Lilly, on the show after their earnings, and he defined this as maybe late in the first inning in terms of the growth dynamic. They are not promoting this. There are many different options and optionalities of how they can grow this product going forward.
Okay, so you're as bullish today as you have been, it sounds like, about GLP-1s.
I believe that the GLP-1 class has multitude of additional areas that they can keep moving into, and we're going to see that card turn on more indications and more potential areas for expansion going forward. Yes.
Okay. What about healthcare as a space by itself? It's in the lower part of the middle of the pack, if you will, right?
Yeah.
It hasn't had a bad year.
No.
But when you look at 9.3% year to date versus some of these other sectors, it just doesn't really excite you.
Yeah.
Is that going to change?
There's a little bit of an identity crisis in healthcare broadly. If we are talking about the pharmaceutical complex, especially in weeks like we had last week, I think there's an element of the defensive nature of those companies that really stands out and stands true. And you saw that during a very volatile week, in fact, and the liquidity, the cash flow parameters around those companies. And then on the flip side, you have something near and dear to my heart, which is mid-cap biotech.
Okay.
And it is almost the poster child of what we are seeing when we talk about the small caps. You were speaking to the guests earlier about that front. The volatility that you expect to see from the small cap universe is going to be just that, and then add in the idea of the volatility of clinical trials and catalysts, and that's what mid-cap biotech has offered this year. So extreme growth potential with large amount of volatility, and then the defensive characteristics and nature of large cap pharma have been the barbell effect we're seeing right now.
Where do interest rates come into this conversation,
Yeah.
if at all, when you're talking about enormous sums of money that are being bet on these drugs eventually coming to market? Theoretically, you're going to have to borrow money at some point at what was high rates. Does that play into this picture?
Absolutely. And I think one of the issues for biotech over the last number of years has been how it is the poster child for that long duration asset. Biotech typically is raising money consistently from the equity capital markets and investors to fund these trials. They are long term. It's not a fast adoption to be able to bring something to market. It can take upwards of 5 to 10 years. So when you do talk about the correlation of the XBI, the biotech ETF, to the rates markets, it is real. It's an inverse correlation. And what we have seen historically in prior periods, and what many are expecting going forward, is that when rates start being cut, you will see a tailwind to the biotech sector.
How active have you been of late in the space? Are you an active, looker for names,
Always.
a buyer?
Always.
Give me a name from one of the most recent purchases that you've made.
Yeah. So one name that's relatively new, I would say, in the last couple of quarters is based on a large theme that we've been following. And it really is a cornerstone of biotech is the regulatory environment. And the regulatory environment in biotech is very much predicated on the FDA. And when you see major changes or ways that the FDA is streamlining the ability to bring a drug to market, you take notice. If there's new people at the helm, if there's new approaches to create pilot programs. And we saw that in the rare disease and orphan disease category. These are diseases that usually affect less than 200,000 patients. The ultra orphan can be less than 15 or 20,000 patients in the US. And the question is, how do you bring drugs to that market. It's a very small market. One such company that's doing something in this space is called Applied Therapeutics. APLT. And they may be a very large beneficiary of some of these changes that are occurring. They are going in front of the FDA over the next couple of quarters with 2 different programs in the rare disease field. And it is incredibly volatile. It will have a lot of binary outcomes here going forward, but that's something that has definitely caught our attention for the potential outcome for patients here as well.
Okay. A name Syndax I have on my list. Is that something you've owned for a while?
We have owned it for some time. It is one that I absolutely believe is going to see some major inflection this year on the back of their 2 late-stage programs. And they are also going in front of the FDA regarding 2 different drugs in the oncology space. One is for pediatric AML, acute myeloid leukemia. They are set to get a decision before year end on that front, and graft versus host disease. This is a company that we believe has the potential for multi-billion-dollar peak sales of these 2 products. And again, very importantly, the demand and the necessity is there for patients. So we're excited about that.
I'm sorry. You still own Maris?
I do.
Yeah.
I do.
Still as optimistic about this name?
Still as optimistic as ever. They're going to have additional data in the head and neck cancer space going into the end of the year. Again, the platform that Mirus has, not only do we believe that what they showed in their trial in head and neck cancer was a success, but we believe there was a validation effect to the platform they have in oncology in bispecifics. So very, very excited about what they're doing there.
Thanks for coming by and visiting
Absolutely.
with us again. We'll see you soon.
Very nice to see you.
Michelle Ross joining us here at Post 9. Up next, the case for caution. Stocks lower after a very volatile week, as you know, on Wall Street. Rockefeller's Jimmy Chang is back with us today. He'll have his latest forecast for the market and the sectors he says are seeing some serious strength right now. We'll make his case after the break.
DTESPX.com.
We're struggling today to hold on to the momentum from late last week. Seesawing a bit here as we head towards the close of trading on this Monday. Investors looking to this week's critical economic data, including CPI on Wednesday. Joining me now at Post 9, Jimmy Chang of the Rockefeller Family Office. Welcome back. It's nice to see you. You say in the notes today that the market psychology has been altered. In what sense?
Yeah, I think prior to the recent sell-off, there was this expectation of a Goldilocks environment with the Fed about to cut interest rates. At the same time, people expect a soft landing. But then we got a number of economic releases that tend to point to a somewhat weaker than expected environment. You saw the city surprise index already falling below zero for about 2 months now. And then on top of that, the trigger for the sell-off with the Bank of Japan, unexpected rate cut, along with a weak jobs data. So that led to this so-called unwinding of the yen carry trade. But I think while that issue is put to rest for now, given that the BOJ has capitulated and indicated they're not going to cut interest rates, given the elevated volatility, I do think there's a sense of less conviction about the state of the economy. There's more concern that bad news could potentially be bad news for the market.
Do you think that the upset last week in the market was warranted? Was it justified, or was it an overreaction to, let's be honest. I mean, the labor market. The labor report may have been a touch disappointing, but it's kind of a stretch to suggest that it was really weak.
Yeah,
stood at 100 and something thousand jobs.
Right. I do believe that coming into July, the sentiment was extremely euphoric. And you start to see a little bit of correction leading into month end. You saw the big tech selling off. You saw the rotation into small cap stocks. And back then, they were also doing the Trump trade. But since then, a number of things have changed. I think the election is now too close to call. There are actually people talking about a potential blue sweep now, with Kamala Harris gaining a lot of momentum. So I do believe that the market was due for a pullback. And this was just a catalyst, happening with the BOJ being, given this unexpected rate hike. So that was an easy excuse. And I do think what happened on Monday was overdone, especially that 12% drawdown in Japan that bounced back very quickly. And that was all tied to the yen's action.
You point to the debate over mid versus late cycle. I don't know if you heard the conversation we had at the very top of our program with one of our guests making the argument that all cycles come to an end, and this one's probably getting close to the point that it is, certainly implying that we're more late cycle than maybe some would like to believe. How do you weigh in on that?
Yeah, that's the big question right now, and there are no conclusive data at this point. We have very mixed data. If you believe that we're in the mid-cycle, meaning there's several more years of expansion, every pullback is to be bought, because in that context, earnings will continue to grow. You're still in the middle of a bull market. If you're more cautious that we're perhaps close to the beginning of that late cycle or already in the late cycle, then the pullback may be part of a topping process, in which case you want to get incrementally more cautious. And again, at this point, it's hard to say because we do have additional stimulus coming into the economy. If you talk about the employee retention tax credit, the IRS just announced on Friday they're resuming payment of that very strong, very powerful stimulus, and that's coming to the rescue. Beyond that, we also have another $300 billion in the overnight reverse repo that will get shifted into the market between now and year end. So those will keep the market somewhat elevated. But beyond that, I think it gets really tricky after the general election.
Your positioning perspective sounds to me to be cautious. I mean, income-oriented investments are better than equities, you make the argument. Defensive parts of the market are better than perceived offensive parts of the market. Mag 7 stocks are likely to go sideways. Have I characterized your view correctly?
Yes, indeed. And that stems from the valuation differences. If you look at interest rates, we have normalized to the pre-great financial crisis levels, and the Fed is about to start cutting interest rates. So that makes fixed income relatively more attractive. Equities on the index level still look pretty expensive on a valuation basis, and part of that is due to Mag 7. I do believe that Mag 7 is likely to mark time for a while to let the earnings catch up to valuation. And at the same time, the other part, the rest of the market looks more interesting. And indeed, some of these dividend-paying stocks, telecom equipment stocks, for example, you get PE below 10 times, you get 5-6 percent yield. That combination is pretty attractive in a normal market.
What kind of volatility do you think we're going to have between now and the election? Was last week a warm-up act for what you could have based on polling as we get closer to Election Day? You referenced some of the more recent polls, which suggest a much tighter race, if not a different potential outcome than some were gaming out not a month ago.
Yeah, I do believe volatility will be elevated relative to where we have been in the first half. However, I doubt that we'll shoot up to 65 intraday like we did on Monday.
Yeah, that was something.
Right, but something between 20 and 30 is likely.
20 and 30 is likely. Let me ask you something. Yes, a week ago this morning, okay, markets are going haywire. There's like a panic attack over just about everything. The carry trade unwind. We're worried about the economy. What was happening in your on the front lines where you were? Were you thinking this, okay, this could be something more substantial than maybe we were prepared for? What was the note to clients? Put me inside the room.
Yeah. So our stance was that as long-term investors, we're not going to look at the knee-jerk reactions in the market to certain catalysts. Our view has been that we're perhaps getting late in the business cycle. We favor fixed income. Equities look somewhat more elevated on the, on the valuation side. So it wasn't a surprise that we have a pullback. And in fact, our message was try not to catch a falling knife. But individually, as a portfolio manager on the equity side, that's the time you look for opportunities.
Jimmy, we'll talk to you soon. Thanks for being here.
Sure, pleasure.
Jimmy Chang. All right, up next, we're tracking the biggest movers into the close. Pippa Stevens is back with us once again. With that, what do you see?
Well, Scott, one financial player is banking on another, taking a stake and sending shares soaring. The bank stock to watch coming up next.
4:15 from the closing bell on this Monday. Let's get back to Pippa Stevens now for the stocks she's watching. Pippa?
Well, KeyCorp is the top performer in the S&P 500, with shares pacing for their best day since November 2020 after Bank of Nova Scotia took a 14.9% stake worth $2.8 billion in the regional bank. KeyCorp CEO Chris Gorman telling CNBC it gives the bank strategic latitude to look at and restructure some of its balance sheet. And shares of Monday.com are having their strongest day since May, hitting a new 52-week high after the Israeli-based software company posted better than expected second quarter results. Needham and Piper Sandler both boosting their price targets after the report. Those shares up 12%. Scott?
All right, Pippa, appreciate that. Thank you. Pippa Stevens still ahead. JetBlue shares are pacing for their worst day ever. We're going to break down what's driving the stock lower today. We're back on the bell right after this.
Is less taxing.
All right, coming up next, Disney unveiling big park expansions. We'll discuss what it might mean for that company's stock in the long run. And tomorrow, don't miss BlackRock's Rick Reeder right here on the closing bell, 3 o'clock Eastern Time. The Market Zone is coming up next. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus, JetBlue facing its worst day ever, that stock is. Phil LeBeau is going to give us the details why. Julia Borston on Disney's big theme park spending plans. Mike, I'll begin with you. It's clear we're not going to go in heavy until we get some numbers, whether it's retail or inflation or all the above.
Yeah, it's going to take a little bit of time and data to rebuild any conviction that we are on firm ground in terms of where the economy is headed. Obviously, nobody's saying soft landing is off the table, but at the July highs, you pretty much had a 100% chance, pretty much priced into the consensus. So today's activity, it's definitely a little bit on the softer side, kind of a hangover from the rebound rally last week. You have a lot more stocks down than up. You have a lot more 52-week lows than highs, but it's low intensity. And every day that passes when you don't see that kind of price insensitive, mechanized selling or anything like that that says there's stress in the system, I think you're kind of still in normal pullback zone where you need a little bit of reassurance about the macro, but it's not something where we're just running straight away from it. Credit markets, they keep taking on more new corporate debt, perfectly fine, digesting things in a normal way. So we do have the VIX popping above 21 again as oil goes higher. That just could be flinching ahead of some potential geopolitical headlines.
I think we are readying ourselves for the possibility of some geopolitical headlines really anytime.
Exactly.
So it's, again, yet another issue in the face of the bulls to try and...
An excuse to hang back.
Sure. What do you make of some of the chip action today? I find interesting, and not just NVIDIA, you know, AMD, Micron, hanging in there pretty well.
Yeah, there's a little bit of a return to what did win in the first half of the year going on in the markets here. Now, they had a 25% retrenchment in the sector. So there's plenty of room where it has to really rebuild and prove that it's more than just a reflex bounce here. So I think it's positive. I think that what's interesting is the doubts about whether the cloud platforms and the other investors in AI capacity are going to get a payback. It returns people to, well, all we know is they're going to be buying a lot of this stuff and building for a while. So it seems like that's the sell side trying to push that line a little bit.
Phil LeBeau, give us the details here on JetBlue. As we said, the stock's pacing for its worst day ever. And as we learned last week, feels like travel stocks in general are guilty until proven innocent.
Well, and this is a specific issue with JetBlue. They have been making moves in order to defer costs in terms of plane deliveries, CapEx expenses. They need to conserve as much cash as possible and raise cash, and that's what they've done today. In fact, when you take a look at the debt offerings today, $3.21 billion in debt that they are going to be raising through 3 different offerings, including a convertible note. Now, most of this will be backed by the company's loyalty program. But it comes down to this, Scott. When you take a look at shares of JetBlue, and yes, they are on track for their worst day ever, what you're looking at is a company here that has had their credit ratings cut by Moody's and S&P, and they're expected to burn through about $2 billion in cash this year. So Joanna Garrity and her team are moving as quickly as possible to cut costs and at the same time build up as much cash cushion as possible.
Under $5 stock, something to look at there. Phil, thank you. That's our Phil LeBeau following JetBlue, and what we've said could very well be the worst day ever for that stock. Disney. Julia Borston, tell us what's going on here. Theme park enthusiasts are excited today.
Now remember, just last week, Disney reported a slowdown in its theme parks as part of its quarterly report. But at this past weekend's D23 fan event, Disney detailed its $60 billion 10-year plan to make parks and cruises a key growth driver for the long term. Now, the Magic Kingdom is expanding with a new Villains Land and a Frontierland upgrade, while California Adventure is building 2 new attractions. And Disney just announced 4 new cruise ships, in addition to 4 in the works and 5 already at sea. Morgan Stanley rating the stock overweight, flagging the experiences division's history of high and rising return on invested capital. And building on the success of this summer's franchise films, of the 7 movies that Disney showcased at D23, 5 were sequels, including sequels to Toy Story and to Frozen. And as Disney works to diversify away from the struggling linear TV business, we're seeing its bet on Epic Games, with more details coming out on its plan to integrate characters into Fortnite, with some new launches as early as this week, Scott.
Julia, thank you. 2-minute warning. Julia Borston, thanks for setting us up for that. I'm looking at yields. They're down, obviously, across the board today, other than at the very, 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 very short end of the curve. Are we in a situation where, falling yields for the meantime are viewed as a negative because they're reflecting some caution in the market?
I think if they're falling quickly, if they get toward the recent lows, which are under 3.7 for the 10-year, probably so. Probably a beneficial effect today of the lower inflation expectation numbers, the 3-year inflation expectations really coming into line. And so the market's positioned for benign inflation data, but I definitely don't think you want to root for a huge rally in bonds. The good news part of that is in the last several months, bonds are kind of acting as the proper offset to equity risk, the way that they, do in the textbooks. And so, if you have a little more turbulence in equities, presumably your bonds are going to hold up or even appreciate a little bit here. I don't think it's going to make up for any possible further, correction if we go back toward the lows, which is only a few percent down from here from last Monday. But it is something that I think helps act as a buffer in the overall market.
So tech number one today, it's an NVIDIA and Apple-led story there, utilities. So as you said, a touch defensive. It's energy in its own way defensive because of concerns geopolitically.
Yeah, defensive and quality and consumer cyclicals. I mean, Disney not getting a bid on that news. It shows you if you really do have a strong view that the economy is strong here and it's going to reaccelerate, so much stuff looks cheap, but nobody can really make that leap right now. We're going to have to hear from Home Depot and Walmart to get a better sense.
Looks red mostly today. You see the NASDAQ, though, looks like it's going to eke out a gain here. That'll do it for us here at the New York Stock Exchange. USA Volleyball, our ladies, the silver medalists, are doing the honors today. It's great to have them here. Congratulations. I'll see you tomorrow in overtime.
That's the end of regulation. USA Volleyball ringing the closing bell at the New York Stock Exchange. Xometry doing the honors at the NASDAQ. Well, stocks trading in a very tight range ahead of retail earnings and inflation data, with most S&P sectors lower, small caps pulling back as well. Looks like the S&P is almost perfectly flat here. We'll see where it settles. That's the scorecard on Wall Street, but the action's just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. Well, coming up this hour, a major price target hike for $800 billion pharma giant Eli Lilly. We will talk to the analyst who just upgraded the name to buy and raised his outlook for the stock by $300, calling it a high-growth unicorn. Plus, NVIDIA bouncing back in a major way today. But fellow chipmaker Qualcomm is under pressure. That's after Wolf dropped its outperform rating on the stock. We will hear what's behind that downgrade in just a moment. And Rock Creek founder Afsana Beschloss joins us with her read on the market volatility and how the 2024 election is impacting her investment decisions. But first, let's bring in our market panel to break down today's action. Joining us now, Ryan Dietrich from Carson Group and Michael Santaterra from Sylvant Capital Management. Good afternoon to both of you. Unchanged, Ryan, on the S&P. I mean, man, what a difference a week makes after the stark sell-off we saw last Monday. I mean, we talk a lot about seasonals in August, but here it is.
No, you're right. Thanks for having me back, Morgan. Appreciate it. And yeah, what a difference a week makes, right? I think it's really impressive. We had that big drop last Monday. That's not the impressive part. Then Thursday, we had obviously a big rally. What's happened the last 2 days? Like nothing, right? It's almost like watching paint dry, which we think is a really positive thing. But I think it's so important. I know a lot of guests have pointed this out. For whatever reason, August tends to be that month where these out of the blue, a lot of time international things, right? Iraq invades Kuwait, 1990. I know the U.S. debt downgrade. And then the one I think is a lot like 2015, the surprise Chinese yuan devaluation. That was the first 1,000-point drop ever in the Dow. And that was one of the more recent times we saw a 50 spike in the VIX. That sounded a little bit familiar, and that was a fairly significant low. So we can get into all the details. We think that the economy is just fine. Slowing, yes, but not a recession. And this is just your August volatility, which is normal.
All right. Love the references from history. Going to dig into that a little bit more. But first, Michael, want to get your thoughts here, especially as this does feel like it's the calm before the storm. I realize we're talking about low volatility. We're well into August now. But we do have a number of potential catalysts here for this market at a time where investors are trying to get their footing, whether it is some of the retail sales and retail earnings we're getting, some of the tech earnings we're going to get this week as well. And then, of course, perhaps the biggest, the inflation data.
Yeah, no question. We're about 85% of the way through earnings. So now we're looking back to more macro data until we get NVIDIA in a couple of weeks, which I think will be a bit of a bellwether moment as well. But I would agree with Ryan's output, at least at the end there. There's no question that the growth has been slowing, but does not appear to be recessionary. So as long as the data doesn't drastically change, we've seen inflation sit pretty tight. Lower, but not a lot lower. And at the same time, we didn't see the jobs number get notably worse in July, which I think is sort of in that long-term Fed range from an unemployment standpoint. It looks like things are still on track for growth, and that's a good thing. So now we wait. We watch the paint dry until we get some more data.
Ryan, Russell 2000, the small caps down almost 1% today. It was really the big cap tech names that led for the market. And you saw that with the NASDAQ eking out a gain here on this Monday afternoon. The rotation we were talking about before we got a correction or a pullback, depending on what average you're looking at, does that still have footing here?
Now, we think it does. And again, it does come down to inflation, which we're going to find out with the CPI coming on Wednesday. And Mike pointed out before we joined, right, the 3-year expectations on inflation, according to the New York Fed, is the lowest it's been in the time of their survey, which is at least 11 years. So we're seeing inflation coming back. And we do think, the idea that Fed rate cuts are coming. Yes, we're in the camp. Maybe they should have cut before, but maybe we get 50 in September and then kind of reevaluate. But the bottom line, again, is the economy's strong. I mean, look at productivity numbers, right? We haven't talked about this yet. Productivity has been really strong in our country for over a year. The last time we had extended strong productivity was the mid to late 90s. Another time where the Fed was able to cut a couple times, wages stayed high, economy wobbled, but then expanded higher. And again, we think, this rotation trade, you want to call it that. I mean, we like industrials. We like financials. We do like small and mid caps as well. We're overweight those areas. We don't see a recession, and small and industrials and financials led last week, and they're hanging in there again. And we think those are some areas that are still going to do pretty good the rest of this year.
Michael, what are you buying here?
We still like the stocks we've liked pretty much all through 2023 and into 2024. We like NVIDIA on this pullback. That's been one of our long-term holdings. We've owned it since 2020. We think that's still got the best fundamentals in the space. And despite the fact that there's a lot of fear and hand-wringing around the DOJ potentially looking at them, as well as some of the issues around the Blackwell launch, we think NVIDIA continues to do well, continues to dominate. This is a very long-term prospect on the generative AI story. We like Eli Lilly in healthcare quite a bit. We're big fans of the Deutsche Bank upgrade today, also a stock we've owned since 2020 in the Focused Growth Fund. And our goal here has been to just ride these trends when the expectations are wrong. We've seen 2020 expectations for the Monjaro market was $250 million on the sell side. And then 2 years later, they did $5.2 billion. So we know that number continues to just exceed investors' expectations. They continue to grow the market, expand the market, reprice the market. We think that works well in healthcare. And from a sort of a little bit of a cyclical growth name, we're big fans of General Electric, believe it or not. Not a stock we thought we'd own for a while, but the conditions for growth were met. The key metrics were inflecting. And as they continue to do exceptionally well at the one thing they've always done well, which has been aerospace and defense, particularly engines, we like the short body and the narrow body plane engines with the LEAP deal. And we like the slow but steady recovery at Boeing at some point when we see more production from both Boeing and Airbus. Keeps those engines getting sold, keeps those service margins rolling in. We think General Electric's got good prospects going forward as well.
What a difference half a decade makes. Speaking of GE. All right, Michael Sansatera and Ryan Dietrich, thanks for kicking off the hour with me in what was a mixed day of trading for the major averages. The S&P, though, basically finishing unchanged here, 53.44, and the 10-year Treasury note at about 3.9 right now. Let's get to one of the big calls of the day on the street. Wolf Research downgrading Qualcomm to pure perform from outperform, citing concerns over Qualcomm losing modem sales as Apple closes in on an internal modem for its new iPhones. Qualcomm shares recovered from their lows of the day, but still closed in the red. You can see down about 1% on a day when fellow chip maker NVIDIA, which we just talked about, jumped 4%. So joining us now is the analyst behind that call, Chris Caso from Wolf Research. Chris, it's good to have you back on the show. Going to start right there with the downgrade. Why now? And haven't we heard this before about internal modems and the decoupling from Qualcomm with Apple, and it didn't actually come to fruition?
Well, we did. We've been hearing it for a while, and we think that's what changed today. It's really what drove the downgrade, that we've been hearing this for so long, and we think that Apple has finally made enough progress on the internal modem in order to get some of those units in there. So what's different now is a couple things. One is that we think Apple has made some progress, and it's not in the numbers for either Qualcomm's fiscal 26 or 27 when this would come in. In addition, since Apple signed that supply agreement with Qualcomm back in September, the stock is up 50% since that point. So it's a combination of finally we're here, is a little bit of boy who cried wolf, and the wolf is finally here, and then plus the stock is up since that situation is why we made the decision to downgrade today.
Okay. You also seem like you're skeptical based on this note on the IoT play. And we know in the last earnings recently, Qualcomm was really talking about industrial IoT.
Well, and when you go back a couple of years ago when this came up for one of the earlier times, we defended Qualcomm stock at the time because what they had in their pocket was very strong auto revenue. And, right now, going out to fiscal 26, they now have $4 billion in auto revenue that's coming in. And the nice thing about auto is you have good 3 years of visibility on that. Again, since then, the stock's up a lot. Auto is now in the estimates. The iPhone reduction is not. And what the company hopes to replace that with, which they'll talk about their analyst day in November, is IoT. And the problem is IoT, it's a more competitive market. There's, more companies in it. It's harder to get visibility. And, with auto already in the numbers, we just think that's going to be a tougher sell to investors.
Okay. I'm going to ask you a twofer here because we have AMAT earnings later this week. How much of that is a leading indicator to what we're going to see more broadly in the second half of the year with semis? And then later this month, we have NVIDIA, and we know it's sold off pretty aggressively, but now people are buying again.
Yeah, so for Applied Materials on Thursday, we think, kind of near term, it's fine. We're starting to see some of the memory spending coming back. What they've already said is some of the China spending is declining for them in the second half. But really, the real prize for Applied Materials comes next year, where we see, stronger memory and then stronger TSMC spending as they bring up their 2-nanometer node. So really, that's what we're playing for on Applied Materials. The other thing we say is Intel, remember, cut CapEx 2 weeks ago. That's going to have some effect on calendar 25. Now, Applied's probably not going to talk about calendar 25 there, but it's something to consider. We think it's about a 2% impact to AMAT. With respect to NVIDIA at the end of the month, listen, we think things are fine. And the bottom line there is demand is well ahead of NVIDIA's ability to supply. There's been all sorts of noise about some of the product delays and whether or not the hyperscalers would step up for the CapEx that's needed. But for right now, and especially for this report at the end of the month, as long as demand is far ahead of supply, we think the company's going to sound good.
All right. Chris Caso, thanks for joining me.
Thank you.
Now let's bring in CNBC's senior markets commentator, Mike Santoli, with a look at how so-called high-quality stocks are performing. Mike.
Yeah, Morgan, they've been hanging in better than the broader indexes, as you might expect, as the tone of economic sentiment gets a little bit more defensive here. So you see on a year-to-date basis, this is the S&P 500 high-quality ETF. It's one methodology for screening out better balance sheets and returns on capital. And it has opened up a pretty good lead against the broader S&P 500. So, yes, it's a big tech holding in this ETF. It's like 1/3 technology, but it's also got a lot of things like staples such as Costco and Johnson & Johnson, which has had a great run in the last month, is also a very big holding. So far, it's doing what it's meant to do when waters get a little bit choppy. Now, on the other side, talk about the parts of the market that have really been abandoned. The airline index, obviously that JetBlue news today did not help this. But if you see where this has brought it down to, down 4% today on a 5-year basis, it's obviously down 50%. But I find it interesting that we're essentially at these significant lows that we have only really exceeded during the pandemic. So basically, investors are assigning very little prospect of near-term improvement in terms of profitability in this group. Now, this also gets to a different point, which is if you're an economic bull, if you think the U.S. economy is just having a stutter step and is going to pick up again, there's just a lot of parts of the market that have been discounted severely, going in entirely based on another view. So, it's definitely some opportunity if you have a variant perspective on this, whatever kind of landing we're going to have, Morgan.
It also kind of speaks to, when you look at the airlines, it kind of speaks to the impact. And this has been, sort of an active debate. Adam Crisafulli, who's on the show regularly, has talked about it. The impact of disinflation and even deflation on the companies themselves after such a strong run with earnings these last couple of years. I want to go back to the quality stocks for a second, because Bespoke today basically pointed out that dividend stocks have outperformed since the S&P 500 peaked in mid-July. So when we talk about quality names, how much of that speaks to the dividend component as well?
Yeah, the huge overlap with the dividend stocks, in particular the dividend growth parts of the market, I would say. But the other thing there is yields have come down so much that on a relative basis, the equity dividend yield is starting to look pretty good again. And so all that's working in favor of those parts of the market. Again, you can't necessarily say, well, that's it. That's going to be the whole trend for the next couple of years. But for right now, those parts of the market where people are willing to give up some of the great upside in a very aggressive momentum market are paying you back.
All right. Quality stocks, quality analysis, quality correspondent, Mike Santoli. Always
Thank
great
you.
to get your thoughts. We'll see you later this hour.
See you soon.
It's been 1 week since the yen carry trade unwind sparked a massive global sell-off. And a number of firms are sounding the alarm that the volatility is not yet over. Up next, Rock Creek's Afsana Beschloss gives her take on this uncertain environment and where she's putting money to work right now. And later, Eli Lilly has surged more than 50% this year. One analyst thinks the stock has another 15% rally in the cards. We will get the bull case for the pharma giant over time. It's back in 2.